Our final presentation before the Q&A is our financial outlook with Olivier Leonetti.
Thank you, Antonella, and good morning, everyone. As you can infer from our presentations today, we are excited by the opportunities facing Johnson Controls. Our customers are exposed to a series of inflection points, which are going to make this decade one of the most exciting decades for the smart building industry. We believe that Johnson Controls is uniquely positioned to solve those critical challenges. Our customers, large and small, need indoor environmental quality, decarbonization of their buildings, and an improvement of their service outcome. We believe that the breadth of our product portfolio, our ability to generate insights from those multiple data points with OpenBlue, and our ability to execute on those insights through our direct field presence represent a set of key competitive advantages which are critical to be a smart building solution player. This strong competitive position serving those secular market trends has and will allow us to build on a position of strength. We have a compelling financial profile, a strong track record, a solid balance sheet, and we expect to deliver an attractive financial performance from a top line, profit, and free cash flow generation standpoint. Looking back, and George went through this recent history at Johnson Controls. We have been over the first 4 years post-merger, we have been focused in creating a smart building solution leader through the rationalization of our portfolio, the strengthening of the fundamentals of the business, by reinvesting also in our business, and by also refinement of our strategy. And we have now also a new operating model. And this work was completed in financial year 20. And we have since then been able to be fully dedicated to competing as a smart building solution player. And this privilege of focus translated during financial year 21 in an above market growth, an increased level of profitability, and a significant free cash flow generation. And we believe as a company, we believe as a management team that the best is in front of us. We believe now we are ready to outperform. If you look at our market, and you can see that on this chart, we expect our end markets to grow at a CAGR of 4 to 5% over the next 3 years. And those markets will largely be correlated to nominal GDP. As you can see also from the chart on the left, we believe that the market across all geographies will grow over 4%, with the Asia market expected to have a growth rate in the high single digits rate. From a vertical market standpoint, we expect the various markets we serve to grow mid-single digits or higher, most particularly in the industrial and data center markets, which are anticipated to grow high single-digit CAGR to financial year 24. And we believe that this market growth will be supported by the strong secular trends we have been discussing through the morning. What are those? We have aging existing building equipments which are not able to perform and deliver the adequate indoor environment quality or to meet the ambitious decarbonization goals of our customers. As an industry, as a company, we have now the technology from a product standpoint and also from a software standpoint. We have the technology to solve those complex problems while delivering an attractive return on investment for our customers. Now, if you look at the opportunities we are facing as an organization, we are very, very excited. And we believe that the best is in front of us as an industry and as a company. We are serving exciting new markets which are large, growing, and we believe that Johnson Controls has a strong right to play and to win in those markets. We believe that our complex customers' problems cannot be solved in an optimal manner at the level of an HVAC equipment, and that an optimum outcome can only be delivered through a smart building solution. Those accelerated vectors of growth include serving the smart building and the decarb market, serving also our service market. We see also an acceleration in the digital revenue growth at the company, and also we expect our global products will grow at a premium of the market, powered by the decarb solutions we'll be offering and digital also enablement. Those opportunities and new market will allow Johnson Controls to accelerate the progression of new business models and disrupt the market. What are those? New consultancy revenue business models, new software revenue, new as a service recurring revenue, and new financial models. And those new business models are expected to accelerate and deliver increased recurring revenue with above average margin rates. Looking now at the top line, and you can see that on this chart, our exposure to those end markets and our competitive position is expected to deliver a strong revenue profile. We expect to be able to deliver a revenue growth of 6 to 7%, or close to 2 points above the growth of the market. This will be driven by market share gain in our global product business, thanks to the breadth and technical leadership we have in this division. We expect to grow our service business. As you will see, as you saw from Ganesh, the service business is evolving from a local break fix to regional digital. And we believe that the power of OpenBlue will allow us to gain share in the service business. And we believe also we have the ability to materialize on the market vector of growth we have been discussing throughout the morning, including the decarb market, the smart building market, and the indoor environment quality market. And you might have sensed from our presentations this morning that we have a high level of focus and a compelling game plan to materialize on those opportunities. We have detailed operational plans, we have a strong go-to-market strategy, and our teams are ready to compete. We also expect, in addition to this 6 to 7% revenue growth, to be able to drive 1 or 2 points of additional growth per year through M&A. Let me move now to our productivity program. We expect to drive strong margin expansion at the back of our productivity programs. As we have indicated before, we announced that our productivity programs would deliver $550 million of cumulative net saving by financial year 23. As a reminder, those productivity programs are based upon the standardization and simplification of our operations worldwide across all the elements of our value chain, from product development to manufacturing to go-to-market and support functions. And those productivity programs today are well on track, and we are confident that the quality of our execution will allow us to deliver on those opportunities. We have across Johnson Controls a strong transformation engine which is well integrated across the enterprise. Those productivity programs are also embedded in our compensation plans to further increase focus and ultimately execution. If you look at now our margin by 2024, you see that because of our productivity program, because of the power of leverage, because of the power of execution, because also the improvement in our business mix, we expect to be able to increase our EBITDA margin rate by up to 300 basis points from financial year 21 to financial year 24 to reach a range of 16.8 to 17.3%. Moving now to outlook assumptions by regions and also what will happen from a profitability standpoint. From a regional performance standpoint, we believe that all our businesses will grow at a CAGR of over 4% at the midpoint. The higher growth is expected to be generated from our North America and Global Products division, as we believe that those businesses will be the most exposed to the decarb market trend and also to the indoor environment trends we have been discussing earlier. From a profitability standpoint, we expect the highest level of profitability increase to come as well from those two largest businesses, North America and Global Products, for two reasons. First, business mix, as those two divisions will be the one being the most exposed to the recurring software revenue, and second, the higher impact of standardization, centralization, and simplification will be on those two businesses. We expect up to 350 basis points of improvement for our North America business and up to 250 basis points of margin improvement for our Global Product business. For MILA, we expect an improvement up to 200 basis points, and for our APAC region, an improvement of about 150 basis points. Moving now to cash flow. We have demonstrated over the last 2 years that we were a 100% free cash flow conversion company. And we believe that we will be able to keep converting 100% of our net income into free cash flow, inclusive of the absorption of the cost of our restructuring programs, and deliver more than $8 billion of free cash flow over the next 3 years. The improvement in the level of profit, our ability to keep leveraging our working capital management, our disciplined approach to CapEx deployment will allow us to achieve this goal. Our level of discipline across the organization regarding free cash flow management is high. We have dedicated teams focused on free cash flow generation to ensure execution, and our incentive compensation give a strong weight to cash generation. Moving down to capital allocation, how are we going to deploy our cash? Our high level of confidence and discipline around free cash flow generation will allow us to commit to distribute 100% of our free cash flow in the form of dividend and buyback. We will increase dividend with earnings growth, and we deploy the balance of our free cash flow in the form of buyback. In addition, we will have ample balance sheet capacity to carry out strategic bolt-on acquisitions and target increasing our annual revenue growth by 1% to 2%, on top of the declared 6% to 7% I mentioned earlier. We'll have two cash levers to increase that M&A, to create that M&A capacity. One, the growth in our EBITDA in rate and dollars, and second, if needed, the ability to increase our leverage from the current leverage ratio of 1.8 to 2 to 2.5 EBITDA on a net basis if needed. Now, what kind of acquisitions are we contemplating? Acquisitions are going to be an integral part of our strategy. We want to deploy our cash to deliver bolt-on acquisitions, which will focus on 3 areas. First, improve our digital capabilities. And having digital capabilities which will be leveraged across our product portfolio, service portfolio, and also across our safe and building solutions. Second, we want to improve our product capabilities where we have gap in exciting parts of the market. Silent Air will be an example of the kind of acquisitions we'll be contemplating. And third, we want to do M&A to improve and enhance our service capabilities. Now we will remain rigorous in the way we'll perform M&A. From a target standpoint, we'll be looking at companies with a high level of technical differentiation that can be leveraged worldwide across our portfolio. From a financial standpoint, we'll be looking at financial hurdles such as ROIC over our WACC on a cash basis over 3 years, and EPS cash accretion being achieved by year 2. And we have across the company today a strong discipline, rigorous approach, and a strong integration muscle, which will allow us to deploy our cash through M&A. And our pipeline today across the enterprise is developing nicely. From a capital structure standpoint, we have a strong balance sheet today with significant liquidities. We are committed as a team to a BBB+ credit rating and a targeted leverage of 2 to 2.5 EBITDA on a net basis. Preserving this strong capital structure and green financing instruments, where we have been a pioneer, is critical to us. To conclude, we believe that the smart building industry is facing an exciting decade. We also believe that the breadth of our product portfolio, our digital capabilities, and our direct presence give us a unique competitive advantage to solve our customers' complex problems. We believe solving those will allow us to deliver an attractive financial return to you, our shareholders. This will include a revenue growth of 6 to 7% on a CAGR basis, up to 300 basis points of segment EBITDA margin improvement, 100% free cash flow generation, 100% use of this cash to be deployed in the form of dividends and buyback, and finally, 18 to 21% EPS growth. On top of this, we are targeting to be able to add 1 to 2 points of additional growth from M&A. Thank you.